just get to the hard facts of stuff and get going.
Sure.
So, hello everyone. Welcome to another episode of Chatter. Today, I am absolutely delighted to be joined by a man I spent 2 years trying to get on this podcast, Dave Lauer. Everybody, welcome to the show, man.
Yeah, thanks for having me. Appreciate it. And appreciate the persistence. Sorry it took too long.
Yeah,
I'm glad to be here.
No problem. Well, I mean, you've been busy building Urvin Finance. So why don't we start there? Like, what is Urvin Finance and why have you decided to put it together?
Yeah, Urvin Finance is our attempt to build something that satisfies what I saw and what my partner saw as a hole in the market, which is that retail investors are this new force in markets, and yet they have access to very poor sources of data. And I also see this drive to form and build communities, and nothing that was really purpose-built to do that. And so we thought to ourselves, well, this is something we think we can build. We know all the right data sources, and we can take what we've seen happening on social media and build a platform that's kind of purpose-built for that. So we've got a platform right now. It's in beta for the last maybe 2.5 months now, and it's got the top data sources out there in terms of fundamental data, market data, and charting capabilities, short interest and stock loan data, and analyst ratings and estimates and forecasts and all that, insider ownership and that type of thing, and SEC filings. And then it's also got a platform. It looks a lot like Reddit, and it's a community platform where people are posting and commenting, upvoting, downvoting, all of that. And it's really starting to, gather steam. And it's been really cool to see that, and to see that people seem to like what we've built. It's got a ways to go. We're still in beta, but we've got almost 20,000 people on the platform now in just a couple months. So that's pretty exciting. And we're growing pretty quickly. So, it's been a lot of fun. And then the other side of it is we're building as much content as we can to help educate individual investors and help them understand different nuances of the market, both from a market structure perspective, which is really what I tend to focus on, but also from an investing and financial literacy perspective. And it's great to find people around the industry and in academia who kind of support what we're doing and want to help. And they're recording videos for us and producing content. And that's been great. And is, that's a major area that we want to build out to.
Yeah, and obviously the reason that you decided to put this platform together was because of the GameStop saga, and
yeah.
One of, I think, the most positive aspects of the entire thing, we'll get to the sort of possible crime, corruption parts in a bit, but has just been watching people educate themselves. Like, I have never been on such a steep learning curve as I had whilst I was watching that sort of initial run up for the first month and sort of the fallout from it, and then the second run up in March of that year. And have you ever witnessed anything on the scale of the amount of information that was being put out and the amount of education that was being given to retail investors for free in those moments?
No, nothing. Absolutely not. It's been so cool to see it, and to be a small part of it, and to see the passion, I think, around markets that people have developed, and the interest in market structure. I mean, this is stuff that me and a very small community of people have been talking about for many years, and no one really cared. And now suddenly a lot of people care. And I think that's great, because I think people should care about this kind of stuff. I think this is sort of the foundation of the economy and how capitalism itself works. And so, this stuff matters. And I'm really glad to see that people care about that, and that there's this approach and this philosophy of sharing information. And that is a big part of what inspired us to build this. And the other side of, the saga is this idea that, you have shareholders who are so passionate about the company they invest in. They're the best customers. They're the biggest advocates. And that was a model that we wanted to recreate in how we built our company. And that's why we went forward with crowdfunding, because I think it's great that, I found it very inspirational to see people and how they felt about that company, and what that meant for the company, and how it was the difference between that company existing and not, right? And I think that there's a lot in markets that we can learn from this experience, and I think that's a big part of it.
Yeah, I mean, it's almost as if the investors of a company genuinely want it to succeed and aren't just private equity firms or asset strippers,
Mm.
that a company can succeed under those
Imagine
conditions. I
that,
know, right?
right? No, for real, I think we've lost sight, especially in markets. We've lost sight of what markets are supposed to be for. Uh, a lot of people on Wall Street just see them as a casino, or a way to extract rents and money from everyday people. And I think that's just really messed up. And I think that this is like markets meeting the social media age, and this capability that you now have of self-organizing communities at scale. And I think it's a great thing. And I think that GameStop is sort of the shining beacon of light, of how this new model can be leveraged for everybody's success, and hopefully, as things progress, financial success as well for shareholders. And I think it's something that a lot of even public companies took notice of, and are trying to figure out, is there a way that they can engage shareholders in fruitful ways like that? And that's something, it's another side of what we're building with Urvin, which is to sort of help companies engage their shareholders in unique ways that they haven't really thought about before.
So, what would you say that the primary reason for having a stock market is? So you mentioned there that like it's been sort of, not your word, but like bastardized basically from
Yeah.
its original conception. Like what how would you define like what that is for? Like what is a market there to do? Like what's a stock market for?
Yeah, markets serve two purposes. And this is something that I think a lot of people lose sight of. And it's very simple. It's capital formation and price discovery. That's it, right? Capital formation, that's like that's the primary market. You go public, you raise money by selling shares to the public. That's the function of sort of a primary listing, what one would call the primary market. The secondary market is where trading takes place, when shares are bought and sold by people, and that's where price discovery takes place. And price discovery is the point of markets and of capitalism in general, right, is to allocate scarce resources. That's economics sort of 101, right? And there are different approaches to allocating scarce resources. Communism is one approach, mercantilism another, capitalism is another. None of which I think are very good, but I would say capitalism is the best one we've come up with so far. And when you are trying to allocate scarce resources, you need to know what something is worth. That's the point. That's what markets do. It tells you what something is worth. In communism, you have a Politburo, a central committee that says this is what this is worth, and here's how much we're going to buy. This is what, right? And in capitalism, the market, as this complex, chaotic system, tries to incorporate information in all these ways in order to arrive at the value of something based on supply and demand. And it comes up with an equilibrium price. And so for companies, they need to know what they're worth, because often they have to raise more money at times, right? They do follow-on offerings. And so the market has to give an accurate picture of what that company is worth, both in order for them to raise money, in order for them to compensate their employees, which they usually do through stocks, and in order for them to, in order for shareholders to benefit as, cash flows increase over time and you get returns and dividends and such like that. So, it's a pretty fundamental, markets play a pretty fundamental role in a capitalist economy. And everything works or doesn't work based on how good markets are operating, how efficiently they're operating, and accurately.
Yeah. So price discovery is something I really wanted to get into with you, because No, I'm going to lay out my understanding of why I think it doesn't exist in the current US market, and then you can tell me if I'm wrong here in my
Okay.
assumptions, right? Because I think I'm not the only one who has this opinion of the people who are going to be listening. So my prior to GameStop, my understanding had basically been the stock market is, say I have 100 shares of Apple and I want to sell them. I go and like put them up for sale in the market, basic understanding. But and then someone who wants to buy 100 shares of Apple comes along and goes, "Oh, okay, I'll buy that." Right. However, what
Right.
seems to happen in my understanding of it is someone goes, "I want to sell 100 shares of Apple." Market maker comes in the middle, goes, "Yep, we'll have that." They take them, and then at some point, maybe they sell them on to someone else, maybe they don't. And to me, that just seems like there's no accurate discovery of what the price should actually be based on what other people in the market, aside from that market maker, are willing to pay for it. And that just feels like, especially in the case of if I'm going out into the market and wanting to buy shares that aren't available, that can just be synthetically created by the market makers in order to increase or have maximum liquidity. It feels like that's not satisfying supply and demand. That's just someone saying, "Oh, you want to buy it? Sure, I got it. Yeah, here you go, take it," without actually having it. And it seems to me that that completely defeats the purpose of the price discovery aspect of the market. Like, am I misunderstanding something here?
No, I think that there's a lot of truth in it, and this has actually been so. Trying to think because there's a lot going on in that question and that answer. So first, I will say this. Let's start with the other side. The other side would say there are two mechanisms for price discovery. There's the quote in the market, and then there are the trades that are happening. And so even though you don't interact with the quote, your trade gets printed to the tape. And so there is some price discovery happening. Now, I think that there's a pretty good case to make that if trades aren't hitting a lit quote, that there is a dramatic decrease in their contribution to price discovery. I don't want to say it's zero, but I will say it's dramatically lower than it otherwise would be if it were hitting that quote. So I do think that there is a case to be made that by internalizing and diverting all of this order flow off exchange, that there is a dampening of demand. And so that means the price is not reflective of the actual supply and actual demand. And then the other side of it, which is the supply question, is that's absolutely true. You know, if you're a market maker and you can sell shares without having even located them, it does seem like, and I was thinking about this question the other day. I was like, the number of outstanding shares that a company has is a floor. And it's, you know, obviously more shares can be created through stock loan and such, and that increases the float, it increases the outstanding shares. There's no way for it to go the other direction. Like, you can't actually go below the outstanding shares, and that seems weird to me. I don't have a really good answer for how you would address that, honestly, but something there still, that seems off to me. But, you know, in terms of price discovery, I do think that there is a significant impact on supply and demand through this practice of market makers executing all of these retail orders off exchange. And frankly, they brag about it. Right? They legitimately brag about it. So the SEC has proposed a slate of new rules in U.S. markets, and a couple of those rules would work together to mostly eliminate this practice and bring most retail orders on exchange into these auction facilities. And you know, feel how you might about the auction model. I personally am not a huge fan. I think it's better than what we have today, but I think a simpler what's called a trade at rule would be a better solution. But regardless, the model that's been proposed by the SEC is this auction model. And one of the ways that the market makers are arguing against this model is by saying, well, in the retail auction on exchange, firms would have no obligation to fill orders, whereas in this internalization system, they contract with the retail broker and they have to fill every order. And what that means, and what they say they do, is that means they cross-subsidize. So they take the money they make from the stocks that are easy to trade, and they use that to subsidize and fill orders in stocks that are less liquid and harder to trade. Now, this is the case they're making. And now when I hear that, what I hear is we provide inferior execution in easy to trade stocks so that we can distort supply and demand in the harder to trade stuff. And I've said this to the SEC. I'm like, that's what they're saying. That's not what we want, right? If something is not liquid, if it's not easy to trade, well, then the price should reflect when there's large amounts of demand for that stock. So I think that this all is sort of wrapped up in this question of price discovery. And I find some of the times I find what these firms, the case that these firms make, to be kind of funny, because I don't think it says what they think it says, because they're so sort of wrapped up in the world that they're in that they don't really think about what they're actually saying. And I think this is a really good example of that.
Yeah, it's literally that scene from The Big Short. Like, there's no, are they confessing? It's like, no, they're bragging.
Right.
Yeah.
Exactly. Right. It's so funny.
Yeah, and like, it kind of brings me to something that I try to ask as many people wrapped up in the financial industry as I can, and is, like, what is the culture? Like, is there a single person? Okay, maybe not. Maybe there's more than a single person, but is there like a group of people, or like at least like a minority, who are thinking, wow, this market is screwed up? Or is everybody who is embedded within the financial industry still there because they're like, well, this is fine, like this is our casino? Like, is there, apart from maybe and then I'm gonna blank on the name, the guy who's basically the main character in Flash Boys by Michael Lewis, is like Bill Huang, I think.
Michael Burry?
No, it's the guy who was working for RBC. I can't remember what his name is.
Flash Boys. Oh, yeah. Brad
Katsuyama. That's who it is.
Yeah.
Like, he seems to be one of the few people in the industry that actually seems to care about having like a free, fair, open, transparent market. Like, is he like a lone warrior? Obviously yourselves as well at the terminal now, but like, is that it? Like, is the industry just only stacked with people who are fine with the way it operates?
No. There are a lot of people in the industry that support what we do. There are a lot of people in the industry that care. It's an industry made up of people, right? And lots of people feel believe different things and feel different ways. So I think, broadly speaking, it's a terrible industry. And it's filled with a lot of awful people, but it's not all awful people. And I know a ton, I know so many people in the industry that are good. And even, I say that, but it's sometimes people will do things that they don't see as awful. And they're not a bad person, but the incentives are completely warped, right? The incentives are not aligned with this sort of societally beneficial outcomes. And that drives even entire firms to do things that I think a lot of us would disagree with. And I don't know that that means they're bad people. That there are lots of bad people, right? There are lots of people that break rules purposefully. And, we see this in enforcement actions, not enough enforcement actions, but we see it, right? But there are, someone like Brad's a great example, and he's a friend, and I love what, I helped IEX when they first started. I've been a fan for a long time. I think I know a lot of people at the company, and they do it. They do it because they care. These are all people that could probably be making more money in other places. And they've done very well at IEX for sure, but that was a crapshoot. And, a lot of people don't recognize the kind of risk you take when you jump into a startup, especially one which, is somewhat mission driven as well, which, I think is part of what we're doing too. But I helped to create an organization called the Healthy Markets Association, and that was an association of firms that wanted to make changes to market regulation. A lot of the same changes that we talk about as ones that retail should support, those institutional investors supported. So there are lots of good firms. There are lots of good people, and there are good people at bad firms. I have people reach out to me all the time, and look, it's hard to judge someone for doing what's right by their family, and they get paid a lot of money, and they have a career that they have built, and it's easy to say, well, you should leave this company that you're working at, but that's easy to say. It's often much harder to do. And so I know people all over the place that reach out to me and want to talk and want to support what we do in whatever way they can, but they can't do it publicly, and they can't, their bosses can't know that they're doing it. I think a lot of people in the industry see these issues and have talked about them for a long time. I think the thing that was missing, frankly, was a regulator that was willing to sort of stand up to very powerful firms or very powerful people. I think we have that now. But these things all take time. It takes time to undo decades worth of, structure and rules and even legislation.
That's interesting that you say you think we have that sort of regulator now. And because I posted on Twitter just when we started saying, does anyone want to ask me a question? Or when I asked Dave a question. Yeah. So a couple of people have mentioned things about the SEC and Gary Gensler. What is your take on it? Because there was a lot of positivity when he first came to the SEC. People were looking at him. I watched some of his lectures back when he was, I think it was MIT, and he was doing ones on like cryptocurrency and cryptography. And it seemed like he genuinely had an understanding of the markets and had a view that there was a way to regulate them that would not cause them to all come crashing down. And then it seems like his rhetoric has slowly been toned down over the past sort of year and a half or 2 years since he took over. And it seems like, especially, I think he really missed a trick on SBF, on Sam Bankman-Fried, for whatever reason that is. We'll not speculate. But do you think he's someone out there like genuinely interested in trying to bring some of these large financial players under a bit more control, or is he falling victim to industry capture in the same way that many regulatory agencies do?
So I'll say a couple of things. First, on SBF and FTX, a lot of people were very fooled by that. A lot of international money from him. Yeah, a lot of international regulators, a lot of politicians took a lot of money on every side, right? There's no one that sort of has their hands clean here. So I think that I'm going to leave that because, that was a pretty messed up situation. And, criminals are really good. Like Bernie Madoff was really good at having people not see what he was doing. And that's usually what very talented criminals are good at. I think that the other side of that question, I have what appears to be an unpopular opinion that yes, I think Gary Gensler is trying to fix things and trying to come in and take on some very powerful firms. I've been around this for a while. I've seen several SEC chairs and many SEC commissioners, interacted with many of them. And none of them have been willing to take on these firms. And so I think it's very easy for people who have never really paid attention to the regulatory process in the past for the last, let's say, 20 years to come in and say, why haven't changes been made already in the next, why don't you just change things today or tomorrow or in 6 months? And it's very easy to say that. And it kind of just doesn't acknowledge the fact that there are laws that have to be followed in order to create new regulations, and that you're dealing with a system that's been in place for decades. And, it's been designed to look good and to be defensible and to make it easy to sort of sow disinformation and gaslight people. And that these are, Citadel, Ken Griffin is one of the top political donors to the GOP, right? Like, what, you think that's easy to address? Like, we are dealing with a very corrupt country and a very corrupt political system, and often with regulators that have been captured in all sorts of different ways, whether it's sort of subtly through big law and fancy, perks, or whether it's explicit revolving doors where top people at regulators are now working at Citadel, right? So person after person from the Fed, from the SEC, have gone to work at Citadel and now come in to lobby on a regular basis with people that they worked with in the past. Like, who thought that would be easy to change? And it's funny, like, from Gensler's perspective, he can do no right. So everyone in retail that I talk to is like, why hasn't it been fixed yet? What's going on? And everyone in the industry is like, why is he doing so much? This is crazy, right? Like, he's a nut job. What? All these new regulations. And retail's like, what are you talking about? He hasn't done shit. And everyone else is like, hey, this is the craziest liberal nut job I've ever seen. And it's like, it's like you're sitting in the middle and you're like, what the fuck am I supposed to do here? So, not only is it an impossible situation, but the equity market structure proposals that came out last December are the first significant changes to markets in 18 years, since 2005. They would most likely end Citadel and Virtu's control over markets. Like, they specifically are targeted to do many things, but this is one of the things that as an outcome of the regulations that would happen. It's exactly what people want. And so many people, so many retail investors who don't think he's doing the right thing on equity markets, we've tried to explain it. We've tried to point out how important it is. And we've gotten so many people sort of on board with that. We've gotten thousands of comment letters filed, through our different initiatives. And I think that's wonderful and it's amazing. And it's exactly what people should want to do. They should want to be involved in the regulatory process. But at the same time, again, it's like, I think expectations that, result in thinking that he's not doing anything, I just think it's it's kind of disconnected from how the system works. And you might say, well, that means we need to blow up the system. And oh, fine, you can believe that if you want. But then, okay, so what are you doing to blow up the system, right? And how do you do that without causing mass poverty and mass economic pain? And what comes out of it? Like, what do you have on the other end of it? I struggle to see the answers to those questions. And then, like you're saying, on the crypto side of things, I don't know. I haven't engaged with the SEC much on crypto. I talk a lot about it on my podcast. I've had people, we've devoted several episodes to talking about crypto. We're doing another one next week. And trying to say, is crypto a security? What do you think from a legal perspective? What do you think from a financial and securitization perspective? And, I'm not going to sort of pretend to know the answer. I think there are many cryptocurrencies that have a lot of aspects of securities. And, what I think Gensler did is he came in and he said, these are the tools I have. Nobody is doing anything. So maybe I should. People say, well, the CFTC should. Well, what is the CFTC doing? Did the CFTC figure out FTX? No. Did the SEC? No. I think you see a huge number of people lose a lot of money through scams like that. And as a regulator, if you care, you say, man, maybe I should be doing something. And if no one else is going to, if Congress is not going to act, which is really what should have happened this entire time, Congress should have explicitly laid out the framework for what these things are, who's going to regulate them, and how. If you're someone who cares and doesn't like to see people being scammed out of money, often people that can't afford to be scammed, I think it is a very natural impulse to say, I'm going to try and do something. And I do think if you look at his record in the courts and the SEC's record in the courts in crypto, it's almost flawless. And almost, of course, because there have been a couple of defeats, especially recently. But before that, I think the courts were very much on the SEC's side. And I don't think anything is really settled at this point on crypto.
Yeah, I mean, I know there's been a lot of controversy around the Ripple court case. And I'm hoping to get Jeremy Kaufman on from Odyssey, who really has been very, very deep on that. So I will not go into that there because I have not done enough research on it yet to give an accurate opinion or ask some real good questions on it. But say you could go and change like one rule, or make up one rule, or remove one rule or regulation within the US stock market. Like, what would be the thing that you would focus in on to try and make it maybe a more fair and transparent market?
I think that's a really hard question to answer, mostly in that market structure is relatively complex. And it's as soon as you start to sort of pull a thread, you realize how interconnected everything is. So I'm going to cheat and I'm going to say I have to at least get two rules. But the one rule that I would really focus on is what I call the trade at rule, or the minimum price improvement rule. And this is something that most other markets around the world have. And what it says is, if you want to execute a trade off of an exchange, you have to provide a minimum amount of price improvement. And that price improvement in the Canadian style of the rule, they say it has to be at least a full tick if the spread is more than a tick wide, or at the midpoint if the spread is a tick wide. And the SEC proposed something very similar in this new set of rules. It's called the order competition rule. And it basically says, it's an even more aggressive form of a rule that I just described. It says, if you want to execute something off exchange, you can only do so at the midpoint, regardless of the spread. Otherwise, you have to send that order to an exchange or to these what are called these qualified auction facilities, which, as I was talking about before, there's some controversy in the way that the SEC has designed the auctions. But I think that rule would do more for market function, transparency, price discovery, and competition than anything else. Now, the reason I say you can't just do that rule is because there's also this rule. It's called the access fee cap. And what it says is exchanges can only charge 30 mils a share for an order that takes liquidity.
Okay, so
that's okay. Yeah.
Brief interlude, and now we're back.
Okay.
So where were we?
I want to say, I described the rule that I think would be most important, and I think we're very close to getting it. I think that there has never been a time when we've been closer. Now, I've been pushing for what I described. I've been pushing for that since 2012. So we're 11 years in. And the rules that the SEC proposed in December came very close. They didn't quite do it in the right way, but they're very close. And the industry has pushed back against some of the rule proposals from the SEC because, for example, this retail auction facility, that's a big unknown. We don't have something like that in equity markets. There is something like that in options markets, but you don't want to you don't want to say, oh, let's do what the options market is doing, because that's like a whole clusterfuck in itself. So, it's the equity markets. It's reasonable to say we shouldn't try something we haven't tried before. And the beauty of the trade at rules, we actually tested that during something called the tick size pilot a few years ago, and we saw really good results. So we know in US equity markets that a trade at or minimum price improvement rule could work. that it would give us good results, that there wouldn't be unintended consequences, and that it's very similar to what the SEC has proposed in the order competition rule. So what I'm working on now is trying to convince the SEC to listen to the comment letter that we the investors wrote, that was filed by thousands and thousands of people, that said, this is good, but it could be better, and here's the right answer. And I found that there are a lot of folks, both at the SEC and even in Congress, on both sides of the aisle, that are very receptive to these arguments. So I'm going to be stupidly, maybe naively, cautiously optimistic, being that it's been 11 years that I've been trying to get these, them to consider these, and not just me, lots of people. This is, these are ideas that are a lot of other people have as well. And I really do think that this is the first SEC in which it's actually a realistic possibility. And so, I'm going to keep pushing for that.
I mean, that is cautiously optimistic, actually. So let me ask you something that I have long suspected. I feel like if you were to go in tomorrow, right, in this hypothetical, wondrous scenario, and just do what many retail investors want, and just sort of snap your fingers and go, okay, we're going to clean this up, we're going to make everything transparent, and there's going to be like an actual, I don't even know what you would do specifically, but like just go in and be like, look, there's going to be no more of this naked short selling, there's going to be no more of this sort of false price discovery based on like the worshipping at the altar of infinite liquidity, and there's going to be like full transparency, no more dark pools, no more off exchange trading. I feel like the entire stock market would fall to pieces. But that's just, maybe that's me being a bit too cynical. What do you think?
I mean, I would hope it wouldn't. I would hope that much of the functioning of the markets is working, and there are things happening in the margins that need to be fixed. And that might sound, I think for people who, for example, are just focused on GameStop, they might think there's nothing else that matters, and that's fine. I understand that perspective, but this is a multi-trillion-dollar machine, and a lot of companies come to it to raise money or to, I think you see a lot of price discovery happening, and you see things that move on news. I think there are there are stocks that are manipulated. I don't think there's any doubt about that from anyone. Maybe people would argue over which ones are manipulated, but market manipulation happens. There's no mystery to that. It happens on the long side and pump and dumps. It happens on the short side on with short selling and abusive short selling and manipulation. I've measured it and created reports and helped companies take action around this abuse. So, I've seen it statistically and quantitatively. I've seen court cases that, uncovered some pretty crazy shit. And there's no doubt that that's happening. I think the question is it pervasive? Is it the entire market? Would it fall apart? I don't think so. But I do think that there are parts of the market where where firms are offsides to a great extent. I do think there are serious issues with what's called proxy plumbing, right? Which really has to do with voting and governance. And I think that's an area that a lot of people should be concerned about, because I think your rights as a shareholder include oversight and governance of the companies that you're invested in and the ability to vote. And that right is often stripped away or truncated and tossed away, unless you're directly registered or unless your broker is doing things in the right way. So I think there are all sorts of problems in many areas, but no, I don't think I would go so far as to say the whole thing would fall apart. I do think there are a handful of firms who might get blown up if that were to happen, and I won't argue that there would be systemic issues from it. I'm not saying that. I think the problems are big enough that they're systemic, and it's a serious issue. But I still think the market functions pretty well in lots of situations, and that's probably not a very popular view. But that's how I see things.
Yeah, I mean, have you read the work of Nicholas Shaxson at all?
No,
No. Okay,
no.
so he's a financial journalist basically,
Okay.
and I think former economist, and he wrote a lot about tax havens and sort of offshoring money, and then he came out with this
Mm,
book called The Finance Curse. And basically, his thesis is that a financial sector in a country, once it passes a certain size, I think he estimates like 10 to 20% of GDP,
mm,
that it becomes a drain on the economy and on other parts of the economy, in the same way that like a resource, you get like a resource curse in a lot of places, say, that are
mm-hmm.
very like oil states,
Hmm.
or
Yeah,
maybe not specifically Saudi Arabia because they're incredibly
yeah.
smart, but
The
like,
Dutch curse, I'm familiar with. Yeah,
yeah.
that's really interesting actually, because when I looked at this, I don't remember, maybe in 2014 or 2015, and you know, I wrote an article about it actually. I used to I used to blog on Huffington Post. Judge me as you might, but it got a lot of eyes. So I wrote a blog post once about how the financial sector in the U.S. as a percentage of GDP had doubled, over the last couple of decades, and how messed up that was. So I totally agree with that perspective. I think that's absolutely right. I don't think that the financial sector needs to be such an overwhelming force. And I think people in finance are really good at, at expanding it, financializing and securitizing everything. And I think that has proven in the past to be a serious problem, crisis after crisis. So, oh, that's interesting. I would be very open to reading that book.
Yeah, I'll send you a link. It's really interesting.
Sure, that'd be great. Yeah.
I think he estimates like in the last decade in the UK alone, not even in America. I think your financial sector is larger as a portion of GDP than ours, which is saying something.
Yeah. Yeah.
Because we have the city of London. Um,
Yeah.
but he basically argues he'd like done some calculations and sort of estimated that 4.3 trillion pounds worth of extra growth had been stolen from like the real economy.
Wow.
Yeah,
That's
not
crazy.
yeah.
I don't
Um,
have, but it sounds realistic to me. If it is truly a drain, and I think there's also, it's a drain in all sorts of ways. Certainly, driving companies into the ground is one of the things that it tends to do. Whether, as as you mentioned briefly before, through private equity or through some of the market manipulation that we see, that's clearly something that people have learned to profit from, and that you would think would be a real problem for a vibrant economy.
hmm. So, like, what do you think the chances of getting like of the market having some sort of like in the future, like a either a blockchain basis or something that allows like unforgeable transparency basically within the stock market? Like, do you think that's a realistic possibility, or is that a bit of a pipe dream?
Um, I I think it depends how far in the future you're talking about. I don't know that we'll live to see it. Let's say. I mean, I think there's probably a a future in which the market is far better designed than it is today. But there's also, a post-apocalyptic future in which it's much worse as well, right? So I I think blockchain is a great technology, um, and I'm a really big fan of certain cryptocurrencies out there. But from what I've seen over almost 20 years on Wall Street so far, is that change is really hard, that things are set up how they are. There are a lot of legacy systems. There are a lot of people whose careers are built on those legacy systems. Just from speaking strictly from a technology perspective, I mean, my career started at a startup where we had a piece of technology that we thought could solve a lot of problems for large banks, and that we thought was far better than what they were doing. And that didn't make a difference, because the people who decided whether to adopt that technology or not were people who had built their careers on the piece of technology that we were trying to replace. And so they were not interested in our technology. And so you find, I think, a lot of that, and that, to me, that's sort of just a metaphor from the tech world of many things on Wall Street. And so the problem that you face is people have made a tremendous amount of money under the current system, and those people are very powerful, and incentivized not to change anything. And so it's a very tough ask to change everything. I think change will come over time, and if blockchain truly is better, then as a system running in parallel, besides the current legacy system, maybe that's where its success and adoption might come from. But I'm not optimistic, unfortunately.
Yeah, I mean, you wouldn't want to be sort of naive, I guess.
Yeah, and sometimes people interpret when I say something like this as like I don't want it to happen, or I'm somehow incentivized and benefit from the current system, and or my company is, and nothing could be further from the truth. I'm a technologist. I believe I'm a early adopter of blockchain and Bitcoin, and I think that the decentralized mindset is something that is truly revolutionary. I don't know that decentralized technologies have caught up yet with like the philosophy behind it, but I am very much I think that's the right answer for a lot of things. I'm maybe more of a cynic than anything else.
Yeah, I find myself increasingly in that camp as well, unfortunately. So I
Yeah,
got two more questions for you. Have you got
sure.
time?
Sure. Yeah.
Awesome. Okay, so first one was from two people actually have commented here, asking about GameStop and DRS. So like they basically the like what I'm gonna wrap two questions in one here and sneak an extra one in. So what do you think of the DRS campaign generally within like the GameStop community, with them attempting to register the entire float? And what do you reckon the chances are if you went out into the market and tried to buy a legitimate share, or tried to buy a share of say GameStop or any company, like what are the chances that that is a legitimate share and not a synthetic one?
So I think direct registration is something that like this community has opened my eyes to, and I think it's a great thing. I think I'm personally a long-term investor. My career was in trading and high frequency trading at that, so as short term as you can possibly be. But what comes naturally to me is long-term investment, and I like investing in startups. I like investing in companies that I believe in, and to me, direct registration is far more aligned with what I think markets should encourage, which is long-term holdings and direct relationships between an issuer and a shareholder. And so those aspects of direct registration are very exciting and appealing to me, and something that we as a company are trying to figure out, like how can we expand the adoption of that kind of thing, and how can we help facilitate that direct contact between shareholders and issuers. So I have become a big fan. And that's why we facilitated the conversation that we did between Gary Gensler and members of the community, where we spent 20 minutes in our most recent Q&A with him on direct registration. Because I think it's an important issue. Is it right for everyone? No, it is a choice that people have to make personally, and there are pros and cons to it. If the community were to directly register the float, I think that would be a big deal, or something close to it. That would be a dramatic statement that would validate a lot of what people have been saying. I think that it's slowed down a lot, so it's maybe questionable whether that can happen. But that would be something dramatic. And And then, sorry, what was the other part of the question?
If you went out into the market to buy a share, like what are the
Oh,
chances it's
sure.
a legitimate share and not something synthetic?
Well, if you buy through, a discount broker, that order is going to go to Citadel or Virtu or one of the other smaller firms, but mainly to those two. And they have this exemption, a regulatory exemption called the market maker exemption that says they don't have to locate a share in order to sell you something. So, that is another thing that we think should be changed and that we should get rid of the Madoff. This is a Bernie Madoff exemption. So the chances are very high they're selling you something without having that share. The question really becomes, do they ultimately deliver that share? Do they fail to deliver it? Or is there something happening within the netting and clearing system that serves to sort of mask the problems with settlement and delivery? And I think that's a far more reasonable question to ask. And it's one that, I've seen people that know more about this than I ask. And so I think that that's part of the problem in our market today, and one that a settlement discipline regime would address. And that's why, that's one of the issues that in our grassroots advocacy work that we believe in, that ultimately the US should try to move towards a settlement discipline regime. But I do think that that's a really big foundational change, and that's something that's going to take a long time.
Well, actually, on that, everyone watching on Thursday, I will be talking to Dr. Suzanne Trimbath again, so tune in for that. So then, last question is, you mentioned cryptocurrencies you find interesting. So Ben Verman will definitely 100% want me to ask this question. Like, is one of them Bitcoin?
Bitcoin, yeah.
But which Bitcoin?
Like Bitcoin versus Bitcoin Cash?
Well, no. Then there's BSV, Bitcoin Satoshi's Vision, which intrigues me as well, because that's made by your guy, Dr. Craig Wright, who claims to be Satoshi Nakamoto, who I had in the show a year or two back, which was very interesting.
I imagine, conversations with him would be interesting. I think he could easily prove that and still hasn't. So I'm not sure.
It's going to court now. There's like, it's there's a new court case, which is literally like, it's like, is he bullshitting or not? So I'm very interested to see what the result of that
Yeah,
is.
but all he has to do is like sign a transaction, right? Like it could be so easily answered.
Yeah, but he claims he lost the keys.
Well, if he lost the keys, okay, but
Yeah.
that's a convenient answer. If you created it, you lost the keys. I mean, that doesn't speak well towards the whole thing in general, right? If you can't keep track of your keys, why do you think anyone else should be able to? But fine, that aside, no, I mean, I am not a Bitcoin maximalist, but Bitcoin I have been interested in since 2010, which was when I bought my first Bitcoin. And you might think I'm filthy rich because of that, but I unfortunately sold those Bitcoin way too early. And that was actually my best and worst trade of all time. Was the same trade. I bought $200 worth of Bitcoin at $2 a Bitcoin. And then in that run up, when it went to 800 and 1,000, I mean, of course I sold, because I was like, this is crazy. And well, there you go. So my best and worst trade of all time. But no, I still hold Bitcoin. I have some Ethereum. I'm a really big fan of Avalanche. I think Avalanche is a really unique technology. It's got kind of everything you want in a cryptocurrency. It's sufficiently decentralized, unlike most of the others. It's got sub-second finality. It's proof of stake rather than proof of work. So it's cleaner, and more, I think, more responsible. And so I've been running a node on Avalanche since almost the chain launched, and I'm just a huge fan of the tech.
Wow. Well, I'm gonna have to get you back at some point to have this proof of work, proof of stake discussion. But for now, we'll have to leave it. Dave,
Sure
it's
thing.
been an absolute pleasure getting to chat to you. Is there
Likewise.
anything you want to like point people towards in terms of the terminal or any like particular bits of content or anything?
Yeah, I mean, if people are interested in what we're doing, they can go to Urvin.finance and sign up for our beta, and it's all free right now. So, I'd encourage you to take a look. And we've got great communities on there, including, a large GME community. I'd also encourage people to go to wetheinvestors.org. And that's our grassroots advocacy campaign. And there's a lot to do over the next year to try and make sure that the SEC gets these changes right, to support them in these changes, because they're fighting a lot of very powerful firms, to work on calling Congress and making sure Congress understands these issues and that their constituents care about it. And these are all things that we're trying to help shepherd along and to be a part of. And, we love that people support what we're doing. And we've had hundreds of thousands of people sign up to support our efforts. And, I think that's probably the most exciting part of all this. So, I hope that there are others out there that want to join what we're doing. And if anyone wants to get involved, please reach out, because, we, the investors, that's just what we do in our spare time. And, we're always open to people helping out with that.
Awesome. Right. Well, I will put links for all that stuff in the description below.
Cool.
But yeah, man, thanks very much. It's been a pleasure.
Sure thing. Thanks for having me.
Hey, everyone. Thanks for making it right the way to the end of the podcast. I love that you tuned in this long. Do me a favor, hit subscribe, because 80% of you bastards are not subscribing, but you're watching my videos. See you next time.